Ladies and gentlemen, boys and girls, welcome to the show. I am your host with the most, Chase Money. Yes, my last name is Money, and what a day, what a week, what a year it has been. And we're going to talk about everything that went down this week. We may not have had the volatility like we have had in the last 2 weeks, but there was a lot that went on this week, and we are going to talk about it. We're going to talk about some of the winners and some of the market movers today. What was going on with the Dow Jones when the S&P 500 is green, why that is the case, and we're going to look at the composition of the Dow Jones. We're going to talk about it all. We're going to talk about Bill Ackman, Jensen Huang, Google, Donald Trump, Jerome Powell, and this guy. And then we're going to talk about some earnings. But before we dive in, if you could please go ahead, like this video, subscribe, hit the notification bell. It really, really helps me out. Let's dive in. So a quick recap of the market, guys. You could see we had some winners here today. We had some losers. Tech, big tech, and healthcare all took it on the chin, with healthcare being the worst performing sector here today, but everything else was actually largely positive. You could say the broad market outperformed, and that they did. If you actually look at this graph right here, stuff like Nvidia didn't perform too well. Stuff like American Express, some of these larger cap names didn't do so well, but smaller cap names, especially cyclical, luxury names, Evolution as well, did very, very well. And then we also did have some defensive names. Waste management was up today. So there is still that defensive tilt in the market. However, equities were broadly green today in what was a pretty red week, all things considered. However, the real index that took it on the chin this week was the Dow Jones. In fact, today was the first time in history when the Dow Jones was down more than 1%. The S&P 500 was actually green. The Dow Jones down 1.33% today. The S&P 500 down up 0.13%, and it all had to do with United Health. United Health Group was down 22%. This was on disappointing earnings. It missed its top line, missed its bottom line, guided about 12 to 15% lower than what the market was expecting. And when you get that type of move, you're going to see atrocious downside, and that's what we saw. And to be honest, we might even go ahead and touch the 400 mark. I wouldn't be surprised to see the stock continue to move lower on the back of what was just atrocious earnings, really, really bad earnings. I wouldn't even be surprised if a class action lawsuit comes to par because of how badly management fumbled the bag. Now, United Health is actually the biggest constituent of the Dow Jones. You see, the Dow Jones isn't market cap weighted, it's price weighted. United Health has the biggest price, the biggest nominal price in the index of $454. And as a result, this brought the Dow Jones down in a very significant way. You could see that United Health Group is 9% the weight of the Dow Jones, probably closer to 8 or 7% now after the move. But these are the stocks in there, and you could see that even stuff like Apple, which is the biggest by market cap, or Microsoft, doesn't have the biggest weight in the index. So yeah, price indices, not my favorite, but that is why the Dow Jones was down in a significant way. It all had to do with just one single stock. Now, talking about single stocks and big bets, Bill Ackman made a huge bet on Hertz. It was up 44% today, up 100% this week, and he believes it can become a tariff winner. Bill Ackman's Pershing Square took a sizable stake. A regulatory filing revealed Pershing Square had built a 4.1% position as of the end of 2024. Pershing has significantly increased the position to 19.8% through shares and swaps, becoming Hertz's second largest shareholder, CNBC reported. And this was his take as to why he actually bought the stock. He said, "We believe that a combination of 1, an improving industry structure and more rational competitive behavior. Number 2, the near resolution of the company's overexposure to Teslas. And number 3, a successful operational turnaround plan under a new management team with a track record of success in adjacent industry. And 4, the company's leveraged capital structure will enable Hertz shareholders to generate highly attractive returns on investment." He believes all of those dynamics are going to come together to see the company bring in $2 billion of EBITDA on a 9.5 multiple. You should see the stock at around about $30 per share in 2029. As of today, the stock trades anywhere from to $9. So, Bill Ackman looking at a conservative 3x from the current price. However, he probably bought in at around the $4 to $5 mark. So he's already up significantly on his position. Now, Jensen Huang was in the news Jensen Huang lost a significant amount of his net worth this week after Donald Trump and the current administration put further export controls on Nvidia. As a result, Jensen Huang flew to Beijing to meet with DeepSeek's founder and China's vice premier, aiming to preserve trade ties and rising US-China tensions. He acknowledged the tightened US chip export controls are seriously affecting Nvidia's business. Huang emphasized Nvidia's commitment to adapting its products to meet regulatory demand. His quiet visit signals the potential severity of China's ban on the H20 chip. If unresolved, the current 5.5 billion Q1 charge-off could grow substantially in the coming months. And that is why Jensen Huang is now making the rounds, trying to reassure some of the friends he's made. Very, very ugly time for Nvidia, and the stock did not act well today. The stock did not act well this week, and big tech as a whole didn't act well. Google was down also. A judge ruled that Google holds illegal monopolies in parts of the online advertising market. This partial loss in the antitrust case could force Google to break up sections of its ad tech business. The ruling marks a major development in the government's efforts to rein in big tech dominance. Things not looking good on the antitrust side. We thought this might ease under Trump's administration, but he is going hard on big tech, specifically as to what happened in the 2020 election, especially with that Biden laptop situation. That was just downright election interference, and now he's letting the FTC go ham on these big tech companies. And I do believe Meta's in the spotlight as well. And on the topic of Trump, and on the topic of Donald Trump, there was a lot going on with regards to the Fed chair. Donald Trump wants Jerome Powell to cut rates. Jerome Powell says that he will remain steadfast in his policy of being data dependent and waiting and seeing. Donald Trump said that if he asked Jerome Powell to leave, that he will. Powell came out and said that he won't. Now, it's very, very obvious why Trump is doing this. He just wants Powell out. Powell isn't doing what he wants. And ideally, what Trump really wants is this man in power. If Powell leaves, if he resigns, the next in line is Kevin Warsh. This guy is the husband to Jane Lauder from Estee Lauder, and Trump is very close friends with him. He would very likely become the next Fed chair. Trump wants a loyalist in the Fed, in the Federal Reserve, and that is this man right here. However, Trump probably doesn't realize that this guy is widely regarded as a monetary policy hawk based on his tenure and public statements. If he were to become a Federal Reserve chair, he would likely lean hawkish, favoring tighter monetary policy to control inflation over aggressive stimulus to boost employment. And that is generally his stance. Nonetheless, this guy and Donald Trump are pretty good friends. And so it's very, very obvious to see why Trump is advocating for him. Now, guys, let's talk about Netflix. Netflix just released their earnings, and it was actually really, really good. They reported revenues of $10.5 billion, equating to 12.5% year-over-year growth. They reported $6.61 in earnings per share. The street expected $5.71, and Q2 guidance came in at $7.03 and revenue of just over $11 billion. They said that their full year 2025 guidance remains unchanged, and they expect to double their ad revenues. This was a very, very solid report. We have some notes here from the actual press conference. The CEO said, "We're executing on our 2025 priorities, improving our sales and film offering and growing our ads business, further developing new initiatives like live programming and games, and sustaining healthy revenue and profit growth. We delivered a solid slate in Q1 with 1 series, Adolescence, and 3 films, Black in Action, Back in Action, Ad Vitam, and Counter Attack, all breaking our all-time high most popular lists. On April 1st, we successfully launched our ad tech platform in the US and are on track to roll it out to our remaining ad countries in the coming months." Now, guys, this is the next big growth driver. Netflix's ad tech platform often is a proprietary in-house advertising technology system designed to manage and optimize its advertising operations. It was launched 1st of April, so just about 2 to 3 weeks ago after initial testing in Canada in November 2024. This platform marks a shift from Netflix's earlier reliance on third-party ad tech platforms like The Trade Desk and Microsoft. It is built to enhance the advertising experience for both Netflix ad-supported subscribers and advertisers by offering advanced capabilities in ad delivery, targeting, and measurement. And ultimately, this is going to drive significant growth because everything is going to be in-house, and they're going to have a treasure trove of data that other participants won't be able to access. This is simply the widening of Netflix moat, and it will definitely become a major player in the ad industry. Now, Netflix's most recent earnings are not on stock analysis. You can see here they still got the previous quarter. However, we can still look at some of the other metrics right here. In the last year, Netflix is up 57%. In the last 5 years, 121%, getting to as low as $190 per share. So a 5x from the lows here in 2022. Now we have to ask the question, guys, is Netflix a buy right now? And you know what we normally do. This is how we do things. This is how we value stocks. I use this valuation process. So we put in the most recent revenue that they reported as per their most recent report, of $40 billion. And I'm assuming 11% growth through 2029. This is actually going to taper off. So you're looking at about 14% next year, very close to 10% in 2029, 20% free cash flow margins. And you get that figure right there at the end of 2029. Now, their current EV to free cash flow is 60. I'm giving them a very, very generous EV to free cash flow multiple of 30 in 2029, right? So with a 30 multiple, an enterprise value of that, subtract the net debt, you get the equity value, divide by shares outstanding, and shares outstanding is going to decrease 1% every single year. You get a 2029 stock price of $987. The current price is $973, and that means a compounded annual return of 0.3%. So is Netflix a buy right now? I say no. However, I could be wrong and these estimates could be conservative. Nonetheless, the stock is just really, really expensive and trades on such a rich multiple. And if it ever does re-rate, if this growth does slow, if margins do contract, you're going to see the stock have a very, very similar drop to what we saw here in 2022. That was what happened in 2022. Revenue slowing, margins contracting, the consumer pulling back, and the stock absolutely plummeted from $690, $700 a share to very close to $175 at the lows, nearly a 70% drop. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.